Welcome back, everybody, to the Investors Roundtable. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And we have a pretty epic episode this week. We're talking about the mindset, the criteria, just what it takes to not only find and be a long-term, not just long-term, an ultra long-term investor, holding those companies for 10, 15, 20 plus years, in some cases, 30 years. I think Adrian will be talking about it in one of those stories, but we're excited to have you all here, and especially our panelists today. We got Stephen Kiel from Arquitos Capital, Adrian Day from Adrian Day Asset Management, Jason Hirschman, Hudson 215 Capital. Gentlemen, thank you all for joining me today.
Thank you for having us.
Happy to be here.
Always a pleasure.
Great to have you guys. So, look, we were inspired. This episode was actually inspired by the episode that we did last week with Steve, who was on there, as well as Matt Peterson, talking about the recent Berkshire Letter and just this idea of Matt gave a great presentation with that, actually doing a formal presentation on holding Berkshire for many, many years and the long-term benefits of compounding and all that. So, I figured I'd start this conversation. Let's pick it up with Steve first, and to kind of give some of his thoughts on what it means to be this kind of investor. I think we should start with the mentality, and then we'll get into the criteria. So start with you.
Absolutely. Well, look, the best companies in the world are the ones that have tremendous internal reinvestment opportunities, right? And so sometimes that's in a particular industry where there might be some sort of monopoly or oligopoly. Look at like a MasterCard, Visa, American Express, something like that. You can own those things literally for decades. If you would have bought MasterCard at their IPO, I believe it was 1996, you'd be printing 25% a year. I used to actually advise a fund that started in 1982, and they bought a company called Balchem, which was a specialty. It is a specialty chemical company, and then it's expanded into other things. And I think they bought it probably 1984, 1985, and still hold it today. And for that fund, it was the number one annual performer. Balchem was, if you look back during that time period, of at least a certain size. It was printing 30% a year, for 35 years. So if you can find a company like that, that's the best investment in the world. And you can take it easy. You're just monitoring. It's great for tax purposes. You're not getting realized gains. And you get to be so familiar and comfortable with the business and the management and what their mindset is. If you can find one or a couple investments like that, it sure beats trying to find a needle in a haystack and turning over all these rocks year over year over year. So look, I think everyone's mindset should be that. And then the question is, you want to be willing to hold it for a long, long time. And then the question is, if something runs up or gets way too overvalued, you can trade around it, I suppose. But when you're in this business and you're really trying to maximize after-tax returns, those are the areas of focus that are going to be the best for your investors and yourself.
Great. That's a good way to kick it off. I mean, Adrian, what are your thoughts on your first take on wanting to hold a company and try?
Yeah,
it's like you have to try it in some respects, right?
I think to a large extent, there is a psychological component to this. And to a large extent, a lot of young people don't seem to have the patience because the world moves so quickly, Twitters and all that kind of stuff. I mean, when I first got into the business, we used to write letters, which the post office actually delivered, believe it or not. And you would write a letter to someone and, 3, 4, 5 weeks later, you would get a reply. And you would deal with a reply. And unless you were going to talk to him on the phone, this sort of process might take months. And you were just used to that kind of thing. And I think, unfortunately, these days, everything's moving so quickly. We don't even have to talk about GameStop, but people are looking for instant gratification in so many parts of the world. So in so many parts of their lives. So there is a mindset to it. And I think, discipline is incredibly important, but also, patience. You just have to be patient and, know that if you hold someone for 30 years, it's not going to go up every day, right?
Yeah, no, Sorry, Adrian, I apologize.
No, I think I finished your question. I mean, obviously there's a lot more to say, but I finished your question.
Yeah, well, no, because it's like this idea of, especially with the stock market. I did an interview on, I think it was on Tuesday with Caitlin Cook that we're going to be putting out next week, where we were talking about this mindset of kind of a Gen Z investor, where, you know, it's traditionally when you think about the stock market, when it trickles down to the lay investor, it's sometimes seen as this get rich quick scheme, or like there's so many people that have gotten rich quick as a result of their strategies that they're employing. You know, so it's almost like there's the get rich quick scheme, and then it's like us here being like, no, hold it for 10, 15, 20 years. It's you know, and you're going to do great.
Hey,
you know?
buy 5 stocks in your entire life as a punch card. Do that.
Yeah.
Good luck with that.
Do that. And then, you know, that's it. That's all you have to do, you know, versus, well, like what?
You know what, though? I mean, to Adrian's point, Adrian, you have a couple, you maybe 2 years on me, 3 years on me. But when I was a kid, you know, I would look at the stock on Sunday morning in the Sunday paper. I would go through the stock list. That's the only time I would see the prices. You know, when I was like 10, 12 years old, I was fascinated with the prices. And once a week, I would see how everything changed from the previous week. And same thing when I used to watch baseball games, for example. Like, you know, you missed the baseball game. There were no highlights. There was no ESPN. I had to wait for the newspaper the next morning to get the box score, right? To see who won, to see what the statistics were. It was fine.
Absolutely.
Perfectly happy.
And sorry, Jason, you'll get in a second. But to that point, I mean, I used to be editor of a newsletter called Inflation Survival Letter. It then became Personal Finance. And this is back in the early 80s. And we did a survey of our audience. It was a bi-monthly, came out, you know, every 2 weeks, and it was printed. So, I mean, and mailed. So by the time people got it, it was probably 10 days after we'd printed it. Do you know what the most popular feature in that newsletter was in our survey? The most popular feature was a little box where we put the price of gold, the price of the German mark, that dates me, right? The German mark, and the price of a Japanese yen and the price of silver. That was the most popular feature. Well, when you're getting your prices on gold from a bi-monthly magazine that's already 10 days late by the time you get it, you have to be a long-term investor, right?
Did you have the price of Bitcoin in there? It was kind of the original price, a tenth of a penny at the time. Updates twice a month.
Jason?
Yeah, I mean, I think it's funny because I have a lot of old stories too, because you know I'm in my late 40s, and so right, we can talk about the Pony Express days, and you know, meanwhile these young kids with no experience are doing option straddles, which is a you know, it's a terrible thought. But you know, just to do one correction, Steve, like MasterCard went public in 2006, and I remember it because I actually bought shares, which I continue to hold. 2006 on June 21st, 2006. I bought 1,050 shares for like a corporate account. And now it's a split adjusted price of $4.56. So that's almost 15 years. And you can just see in just that example, the magic of holding a stock long-term, tax deferred, you know, all those years. And, you know, now we're practically getting, you know, tremendous dividend yields just on off that original basis, right? And of course, tremendous appreciation too. So I will say though, that part of the and it's a little bit of luck, right? Because 2006 was really the beginning of like value at that time had, you know, taken off in 2000. 2006, it was probably the low for growth stocks, or getting close. And so it's sometimes difficult when you have these major transition points and a particular sector or approach gets overvalued, right? So if you were investing in stocks, you know, value stocks in 2000, or growth stocks, let's say in 1999, 2000, terribly difficult to hold them all the way to the present time. So it's a little bit, you know, it's a little bit of luck that comes into it. You know, you getting into a great stock at the right time at the beginning of really an inflection point in the market can really be beneficial.
Absolutely.
Yeah, absolutely. And you know, look, you knew I mean, first of all, congratulations, Jason, for the purchase, and you know, whatever corporate account that you did it for, hopefully they still hold it.
It's my corporate account, so don't worry about it.
Account. There you go. All right. But you know, that idea, you made a great point about the mindset that you said, look, split adjusted to today, it's 4 and change, right? And what's the dividend today per share? You know, and that's, if you think about it in that way, and what that return is on the original investment, what's the yield on the original investment, and forget about what it's at today or what it was at a year ago, what it was at 2 years ago. Look back to the original investment and what, you know, what yield are you getting currently with, you know, virtually, you know, there's probably very, very low risk that's going to be cut anytime soon, and it's going to grow every year, right? So, and that's how the guy that I worked for, that I advised, who owned Balcom, had that same mentality. You know, he would base it off of that original purchase price, and then he would determine both kind of the internal yield of internal reinvestment and the external yield based on the dividend. And that's how he actually calculated the return, not how the stock price did last year or not. He would look at the actual fundamental financials and say, look, they're throwing off this much cash. This is my cash on cash yield. This much is being returned to us through dividends as investors, and this much is being reinvested in the business. If the business is profitably reinvesting it, it's going to grow going forward. And that's a much, much different mindset than investors have today when they anchor to the stock price.
Yeah, it's difficult though, because I mean, it's interesting. In the great stocks, you can look at a chart and you see these small blips in the past that at the time seemed like a tremendous threat. I mean, I remember like MasterCard, we could talk about the whole Durbin Amendment in 2010, right? Everybody got scared, like, oh my God, you know, the swipe fees, you know, these MasterCard, Visa, these oligopolies are going to be decimated. And of course, you look back at it, you think back of it, you said, you know what? So what? Nothing happened. And I like to joke about MasterCard is that the easiest stock in the world to do, you know, your quarterly check. You just open up your wallet or your digital wallet, see that the card is still in there, and then you close it and you're done, right? On to the next quarter. That's all you have to do. So that's one of the benefits of these great companies is that really, you really don't have to do as much work just to stay up on it as you do with researching some of these tiny little companies that you go in and out of and trade around.
And to me, frankly, it's a lot more, for me as a manager, it's a lot more satisfying to look at the portfolios that we own for clients and see, oh my gosh, I've owned that for 10 years. I've owned that for 20 years. That's a lot more satisfying for me, frankly, than it is, you know, to say, oh, look what Ajax Exploration did last week or something like that. But you mentioned a really key word, Jason, just then, and I know we all agree, but you mentioned company, because we've been talking about stocks. You mentioned company, and obviously, if you're going to hold a stock for a long, long time, you have to think as an owner of a company, not as a shareholder, and it has to be a great company, not just a great stock price, a great stock. But that's an obvious point, but I'm glad you mentioned company.
How do you distinguish that, right? And that's the challenge, because you could own, some companies, you could own a number of different companies over the long term and on average do worse than the market itself. And that's where, though, when you're analyzing it, you have to have that long-term growth potential based on high returns of invested capital. And so when you're looking at companies now that maybe over the last, well, when not us, but when other people are looking at stocks that maybe have done well over the past 5, 7, 10 years, think of like a Tesla, right? It's impossible to calculate that. So the stock has done well. The company is not one that you could own on the basis of that kind of long-term reinvestment opportunity and some sort of predictability then based off of that in the stock price. And so, this is where Buffett talks about, look, most of these companies are simply uninvestable. There's nothing you can do about it because you cannot calculate that or feel any sort of level of comfort based on the results, the financial results themselves.
One of the things I do, and maybe other people do it subconsciously or whatever, it might be helpful, but I differentiate in our portfolios. It's on a continuum, of course, but I differentiate between the core holdings at one end and, the short-term speculations on the other end. Now, I'll be honest, when I first invest in a company, I know if it's going to be well, I know if I intend it to be a short-term speculation or a longer-term holding. But when I first invest, I have no idea that I'm going to hold something for 30 years or more even. and Robert's laughing, but you know, I've got stocks that I first bought in 1985 that we still own.
Stock's older than me.
What?
Stock's older than me.
That was an unnecessary comment, Bobby.
You mentioned
unnecessary.
A stock that like 1980. I'm just curious what stock, if you don't mind. And by the way, I just want to mention I do know that MasterCard I do own, and some of these other stocks I'll mention I do own today. But Adrian, what stock is that from 1985 that you?
Well, I'll tell you. But I hate to do this. Can I first of all make a disclaimer? So clearly, no stock that I mentioned today should in any way, should you infer any performance for our managed accounts. Nor should you infer that I like the stock if I mention it and say we've held it for 35 years. I mean, come on, let's be honest. If I'm recommending a stock to an audience and I say I've held it 30 years, isn't it pretty obvious that I like it? But anyway, so nothing I like and nothing has anything to do with performance.
You just happen to own it for 30-something years, but you have no real
opinion.
Positive
it was so
or negative.
illiquid, I couldn't sell it yet.
Adrian's all circuits and wires, okay?
So this particular stock was Franco-Nevada, which is a gold company, gold royalty company. And I mean, I think that's a good illustration, actually. If I may talk for a minute or two, that's a good illustration, and then I'll try and be quiet. You know, when I first bought that, it was based purely on management. Two people, Simon Schulich and Pierre Lasson, two of the smartest people in the resource business. It was based purely on management. They took us out to see some property they had called Hasbrook Hill, and we stood on the top of the hill and we looked at all the other gold mines around and we said, oh, this is going to be good. Well, the truth is Hasbrook still isn't in production and it's a piece of you know what, and they've changed the business model and et cetera, et cetera. But the key is the investment was made on the basis of people. Now, at that point, I didn't dream I would hold it as long as I did. And full disclosure, I mean, for people who know, of course, I know that they sold themselves to Newmont or merged with Newmont, and then subsequently they were spun out from Newmont again. So it wasn't a continuous holding. There was a gap in the middle. But as they developed their business plan and as things changed, then you started to have more confidence. I started to have more confidence in the company. Said, oh, we're going to hold this a long time. And maybe after 5 or 10 years, the realization came that this was a really special company. In addition to the great people, this is a really special company with a great business plan. Let's look at the history. Let's look at the revenue and the revenue growth. And so it developed into a core holding. But I certainly didn't say in 1985, oh, this is going to be a core holding.
I think that's a key point, that a lot of these stocks develop into core holdings, right? You cannot, I mean, all of us, we like to think of ourselves as smart and like to think that we can predict the future, but really we have Bobby's saying no, but we like to think that we can predict a little bit, but really no one can predict 15 years into the future. It's just too difficult, right? So it's a constant process of a stock rewarding you and a company rewarding you with good management, good results, and also good reinvestment opportunities, right? That you continue to see. That keeps you in the game.
Yeah.
Jason, you bring up a good point, because it's even something that I try and think about, setting up Roth IRA accounts, wanting to, go and get a couple stocks that, I genuinely want to hold for a very long period of time. And it becomes overwhelming when you think to yourself like, oh, especially when I'm thinking about Roth IRA, you penalize before 59 if you try and take it, to withdraw, so you really are, and at 32, like I'm genuinely thinking about, okay, I want to hold something for 25, 30 years because I'm now going to want to withdraw it at that point. I mean, there would be buying and selling probably within that, of course, but let's just using that as an example. It's almost overwhelming to think to yourself, like even a company like Berkshire, yeah, it has a great infrastructure. Once that day comes and Buffett and Munger are no longer with us, they've built a platform, a structure in order for it to continue to keep going, for 10, 20, 30 more years. But at the same time, you never know. And it's just that it's almost overwhelming to then think about, like, all right, I want to look at this for that long of time, but it's so hard to wrap your head around when you think about how much things change so exponentially.
I think you need to meditate, Bobby, and try to live in the moment and have presence more for the current, and don't live in the future, live in the now, because that anxiety is causing you self-doubt on your current decisions about the results of the current results of the company. So I think maybe if you got like a guru or something like that, you went on a little.
This is what I do. You guys think this is a show? This is my therapy session. Okay, this is my investing therapy sessions to make sure that I'm not doing dumb shit.
Yeah, it's a little bit of a joke, but I think it's actually true too. I mean, You're looking at the results here. You're looking at the predictability from the previous results over a certain time period. You think it's reasonably priced. Stocks are reasonably priced compared to the financial results. And you have confidence that management can continue it and that the business profile can continue. What's to worry about?
Yeah, right. Exactly. But I mean, it comes back to the point of, like, just, we talk about this a lot with microcap investing, right? Where we want to find a quality business. It's about management, as Adrian has talked about. Jason, Steve, you guys have talked about, many times on this show and others, so it's just trying to develop that conviction to hold. And maybe it's a mental model that you build for yourself. Where, like, okay, I want to hold this. I'm looking for companies that I can hold for a minimum 5 years and then kind of go from there. Right. That's something that I've thought about a lot. I know Jason's thought about this quite a bit. With
microcaps and maybe, it's easier to talk in like 5-year holds rather than 10 years, 15 years, because it's get further and further into the future, it's just too difficult to predict. Like the management team quality comes before, like, the quality of results in many times in a microcap, right? You got the right team, they come together, they start to show results. They're still maybe losing money. They may not be really having that much operating leverage, even if they're making money. It takes time. So with all investing, right, it requires patience, right? You have to give a team, a company, time really to show you results. And I think that's like the word I hate. I mean, we're going back to our Pony Express, like, in my day, people had patience, but really, you need that. You have to be able to, just give the goddamn people some time, and people don't do that. They like, 1 quarter, they blew it, and then boom, they knock it out. And, and we see time and time again with behavioral economics, once people knock something out of their portfolio, even if it's a great company, and then it goes up a little bit more, the psychic pain is too big. They won't buy back in at a higher price, and they miss this tremendous run up. And you see that time and time again. And that's why, in some ways, if you can resist from selling the promising company or the great company, you do yourself a load of good.
Yeah, I'd like to really, really emphasize that, if I may. I think the biggest mistakes I've made in my investing career are not buying the wrong thing or holding it too long. The biggest mistakes I've made are trying to be too clever and sell something that I really like because it's a little bit overvalued. Because I won't say you never buy them back, but you rarely buy them back. So if you have a core holding, you might trade around the edges by all means, trim positions, buy more and so on. But a core holding, if I really like the company, I will never, never, never sell it with the intention that I'm definitely going to buy it back. Because it just doesn't happen, I found.
What do you guys think is harder? Finding that company that you want to invest in, let's just even say on the smaller long-term scale for 5 years, or then holding it beyond that 5 years that you had originally intended?
I think holding it is harder, you know, and I mean, you've just proven it, Bobby, talking about your, how do you make that decision, right? And like, you're worried about all these things in the future and everything like that. And I think you have to create a strategy beforehand, like Adrian, had said, and I would even try to make it as mechanical as possible to say, I don't like to do this, but let's say, it goes up a certain percent, you're going to trim it or whatever. It goes down a certain percent, you'll add a little bit more. You won't make any rash decisions based on quarterly results. Maybe you have to tell yourself, I'm not going to buy or sell until, we get 2 years of unhappiness or something like that with the strategy. I mean, the companies are out there, and what industries generally can perform well, based on historical financial results and the cusp of things like that. I mean, look, the MasterCard, Visa, American Express, buy all three. They're all going to, they all have high returns on capital, right? And invested capital. Buy all three, buy one of them, whatever. Commit yourself to that mechanical buy and sell process if you want to hold it for at least 5 years. But if you're just looking at the daily price, if you haven't thought about this beforehand, your emotions are going to get the best of you. And, it's going to double, and you're going to say, great, like, well, how can it double again? And you'll create these doubts, but it can. So I think, look, we could probably, even amongst the four of us here, and don't down round yourself, Bobby, because you can do this too. We could find 10 great companies at reasonable prices today. And if we were able to make that commitment to hold those for the next 5 years in a mechanical way, we'll do really well.
Everybody listening right now is like, okay, can you guys do that right now? Then give us the
MasterCard.
What are those names?
Yeah, what were those names? I didn't hear.
I got my notepad here. What are those names?
Yeah, tell me one more time.
Look, Bank of America.
Let me just say what.
Let
me just
look,
say one
Altria. That's 4 of them right there.
One of the things I think, one of the most dangerous words, like little phrases that I hear people say is always like, I sold after I updated my model. And a lot of times updating the model doesn't mean improving the model. And people tend to update their model right after the earnings comes out. And believe it or not, they still have some kind of emotional bias, especially if there's some kind of negative shock. And they way over change the inputs in their model. And suddenly the stock they held on for 4 years and loved up until the day before yesterday, now it looks like crap, right? So sometimes, if you hold a stock, yes, and you're surprised by a negative result, you don't have to update that model, that moment, and act at that exact moment to dump it out of your portfolio. And if you feel like you have to sell, just trim it and wait another day or two and see how it feels and see how you feel. People are way too quick to make dramatic changes. And I don't, and then they always, I talk to them like 1.5 years, and we all have stocks, like we hold, and people have it got done well, and they're like, and people just keep getting off the train at much lower prices, and you always wonder, like, why did you get off? It says, well, they had a bad quarter, but you held it on for 6 years. I mean, through all sorts of thick and thin. Why that particular quarter? And something just stuck in their mind, and they got off the train, and they never get back on. And it's certain habits, like just waiting until wait a day if you want to dump something, really are just powerful helpers to really just staying long-term invested in the name. I'm sorry, I'm going on a little bit here, but
no, that's true. But again, for me, it helps to differentiate where they are in a continuum. Because if I've got a short-term speculation, let's say it's a gold mining company and the drill hole wasn't what I was expecting, I should get out, and I should get out immediately. Because the reason I bought it, good drill results, didn't happen. But if I own Franco-Nevada or Nestle or some of these other companies we're talking about, with Nestle, I'm not looking for, did their carnation sales go down by 1% this quarter? I don't even look at that, frankly. It's irrelevancy. Maybe they don't own carnation anymore. I don't know. But so I think there's a totally different response is appropriate to why you're holding a stock and what expectation you have. But I'd like to, Robert Bobby asked whether it was more difficult to find the good companies or to hold them. I honestly don't think holding them is so difficult. Because if you've already made, for me, the way I look at it, if I've already made a decision that this is a core holding, I've got to have a very, very, very compelling reason to get rid of my Nestle, which was the very first stock I bought when I opened my money management business in 1991. I've got to have a reason to do it. And a quarterly miss is not the reason. It's got to be a fundamental reason. So I'm not saying that couldn't happen, because HSBC used to be a core holding for me. Let's say I own that one since 1976, when it was only listed in Hong Kong and they were paying 33% dividends a year.
No jokes, Bobby. No jokes about that. No jokes about 1976.
Core holding that you sell and you turn your back on, no question, you can have that. But I mean, you've got to have, to me, I've got to have a really powerful reason to want to sell one of these stocks, because Buffett, I think, has mentioned, you know, when you sell, three bad things happen. Well, he used to say this. One of them was you pay the broker a commission. That doesn't apply anymore. But you certainly have to pay taxes, and you have to find somewhere better to put the money. And, you know, the truth is, if you've got one of these great companies that you've held for many years, you don't want to pay the taxes, and unless you live in Puerto Rico. And can you find something better is the question.
Right.
I will say one thing. I didn't hold the stock very long, but I did own, and this is a name, Adrian and Steve, you probably recognize, but some of the younger listeners may not, a company called Washington Mutual. And it did spectacularly well for many, many, many years, and then blew up, right? I mean, really dramatically. And so I don't want to emphasize, I do want to emphasize, you got to make sure that the company is still, I mean, Nestle is still Nestle. Nestle, like in the 1970s, still Nestle in 2020. But you know, sometimes there can be underlying changes in a business. And even if you're not watching the company on a daily basis or even a quarterly basis, you have to watch out if there's new risks being introduced that could really expose yourself. And particularly if you're holding a company for a very long period of time and you have a very long cost basis, sometimes it can become a very large percentage of your portfolio. So just because you hold a company for a long time, you still got to watch it. And there's a lot of Washington Mutual investors out there who really screwed up their retirement, I would think, because they weren't paying close enough attention.
Sometimes these changes aren't immediately apparent at what we'll call the headline. You know, you don't see the earnings change, you don't see the dividend change. You know, as you say, you've got to look a little bit deeper to see, wow, something is happening at this company that I don't like. And eventually it's going to affect earnings, reported earnings. Eventually it's going to affect the dividend, etc. Yeah, you're right.
Right. And I'll just do another, sorry, Steve, just to cut you off. I used to own like Big Mo, right? Philip Morris back in the day. And I bought some in 1999 and I was expecting to hold on for a long time. But honestly, I changed. And you can do that too. It's not just the company changing. You can change. You say, you know what, I'm more and more I learn out about tobacco and more I get older and have kids, I don't feel comfortable holding a company that sells these kinds of things. So it's you know, there's a lot of things that go on to like whether or not you hold a company for a long period of time. And I know there's a lot of people who love Philip Morris, love the tobacco, you know, investing, but it's just not something. It's something that I developed more discomfort with. So there's a lot of reasons why some of these long-term holdings can disappear from your portfolio.
Yeah, that's perfectly fine. And in fact, I owned Washington Mutual after the bankruptcy when it was the NOL shell for a few years. So going back to that. But I think, you know, to your point about Philip Morris, Altria, these types of things, you know, you can look at those financials and the characteristics and you see why it would be an attractive compounder. Right. Yes. You might not want to own it for personal reasons or moral reasons or, you know, things like that. And also you do have to consider the regulatory risk and all of that. But, you know, if you want to, I guess, you know, viewers, listeners here, if they want to know what companies have the ability to compound over that time period. Look at the financials of Philip Morris in 1999. Look at the return on invested capital there. Look at the balance sheet, just solely from the financial perspective. Look at the financial statements and try to find a company today that has that. And then, of course, you want to find the qualitative predictability from that as well. But if you look back at 10 years of financials for most of these companies, you can find ones that are you can have some predictability to own for the next 10 years. Now, to the point about Washington Mutual there too, I mean, you do have to look at risks top down. And when you have the economy with what was happening during that time period in the housing market, you might not need to spend more than 5-10 hours a quarter on the financials and the update, but you do need to have some sort of perspective on the overall economy and the direction it's going, because we have technological advancement, and there also are these major risks in the economy that will cause issues for some of these companies that might have been doing well for a certain time period. So you got to layer on that risk perspective, I think.
But I mean, I think to me, but one of the great things about these ultra long holdings that you say is that they tend to do well in any environment. That doesn't mean they don't have risks, and they're not, they're not affected by the economy and by interest rates and by regulatory and so on and so forth. But, again, to look at a company like Franco-Nevada, it's a gold mining company, and yet it has been pretty consistent, even in the period from 2012 to 2015, when the XAU, the index of senior gold stocks, fell about 86%. They still continued to increase their revenue, to increase their cash flow, etc. I mean, this isn't a lecture on Franco-Nevada, but the point I'm making is that the best companies are companies even if they're cyclical, they're companies that can do well throughout the whole course of a cycle, which I guess means they're not cyclical.
Yeah, I mean, I own, let's see, I was just looking at my portfolio to see which stocks I own for more than like 10 years, right? And so I got 5. I got American Express, CME, I still call it the Chicago Mercantile Exchange, ICE, right? International Continental, MasterCard, and Visa, right? All companies that have reinvestment opportunities, but more important perhaps is that it's very difficult to compete with them, right? And sometimes we should also look at the absence of competition. How is a company doing, versus the competition? Can you take away their business? And most of the great opportunities, it's very tough to take away. Once they grab market share, once they grab a piece of business, it's extremely difficult to take it away from them. And that's something to sort of watch for any kind of company, actually. But if you're thinking about holding on something for a long term, like, once they get their fingers into something, right, do they let go or not? So that's something, that's always a question I like to ask when thinking about something long term.
Right. Yeah. I mean, one thing that you guys have brought up quite a bit here is this idea of, being open to changing your thesis. And that, because whether you like it or not, your thesis, especially if you're going to hold it for more than 5 years, that original thesis probably will change. I mean, you guys are talking Nestle, all these different companies, they've been around for so long that the original reason why you probably invested in them has changed dramatically, or not. I mean, Nestle, it has probably the same corporate culture as it has for years. But I mean, there could be other reasons why that thesis has changed over the years. So, I mean, do you guys have examples of times when you've had some of these core holdings, and because the thesis changed, you then decided, you know what, the thesis changed, but that's okay. I'm still going to stick around, because it's pretty easy to make the argument, okay, the thesis changed, and now and something might happen. The risk profile is much higher. I'm probably going to sell. But we never really talk about if the thesis changed, but you kept holding because something about that was attractive. So do you guys have examples of that happening in your careers?
I mean, go ahead, Adrian. I've got something to follow on to you, but yours is a little bit better.
No, after you.
I mean, I usually get into a company that has some sort of mispricing or misunderstanding based on kind of balance sheet characteristics. And so essentially I'm looking for that transition, you know, so I have no guarantee that it's a company I'm going to want to hold for 5 to 10 years, but getting into it, I would like for that to happen. And then it's kind of like, did everything materialize in the way that I wanted to? Did they make that transition to, you know, the cash flow characteristics that I require over time? So I think most of my investments are like that, probably. And I cut the cord if they're not able to make that transition.
Yeah, I'm not sure. I'm not sure that that I agree with your, you know, the basis for your question, Bobby. For me,
good.
Well, for me, one of the most important criteria or criterion for selling is if a company deviates from its business plan. Not so much that it misses. I mean, obviously you don't want a company that continually doesn't execute, but you know, if a company is meant to be a, you know, whatever, a copper company or, you know, a gold company and becomes a marijuana company because they discovered that they could grow marijuana on their gold property, you know, that's a good reason for me to sell. That doesn't mean I can't get back into it. And, you know, of course, companies evolve and change, but is the fundamental, the real core of why you're holding this company for a long period of time, does that remain true? That to me is the essential thing. You know, but if whatever, if Nestle, you know, announced that they were buying, I don't know, whatever, that would be a reason to look long and hard. But, you know, I mean, anytime you have a company for a long period of time, there's probably 3 or 4 central criteria, central factors why you love that company. Actually, that's not a good thing to do. You should never fall in love with a company, but why you're holding that company. And if they change one of them, maybe that's fine, because you look and you say, well, the other 3 things are still the reason I bought for it, are still fine. But if a company changes completely, I'm more likely to sell than to continue to hold, to be honest.
Got it. That was a good adjustment of my question.
And I mean, I'll tell you a good example. I mean, I think HSBC or HSBC Holdings used to be called Hong Kong Shanghai Banking Corporation is a great example, because one of the things that, you know, management is key to me. Management is central. And a company like HSBC always appointed, you know, chairman, managing director, what we would call CEO, always hired them from within. And often they were people who had joined the company out of school at 16 in the mailroom, and sort of, and the reason that was critical was because they had, the corporate culture was ingrained into them. So one person couldn't make much of a difference because there was such a strong corporate culture. And if you'd been at the bank for 40 years, it didn't matter whether you went to Eton and Cambridge or whether you started in the mailroom, you had that culture. And I sold, and please don't everybody send me nasty letters, but I sold when they started hiring a lot of hotshot American bankers from Goldman Sachs, who had no experience at the HSBC culture. And what did happen after 3-4 years? The culture of the company changed. It was no longer the same culture, no longer the same investment.
Can I throw shade, Bobby, at a very famous blogger, financial blogger? Just a little bit of shade. Do you mind?
Uh-oh. Yeah, let's hear it. Okay.
You know, and actually I enjoy his posts very much, but I think he goes and he's looking for like long-term investments. He's always looking for these, you know, stocks he can hold for like 10 years, 15 years. But I don't like the way he goes about it. And I just want to offer like Value Stock Geek, right? Very famous guy. Doesn't get great results yet. Not to say that he won't in the future. Very open with his process. But he's constantly looking at these companies that have been a great business to own for the past 20 years. But then, surprise, surprise, in most markets, they're like very highly priced, right? And we do have to take price into consideration, even for long-term, for compounding. And
do
so
we though?
If you do have some talent, if you're growing your talent as an investor, sometimes if you want to own a stock for 10, 15 years, is to find the stock that's younger, that's building the true value at the beginning of this growth curve, rather than 15 years into it. And I would ask that some of your more talented listeners, I'm sure every listener you have is talented, is to consider looking at some of these younger, smaller companies that are transitioning to greatness, rather than have achieved greatness for 15 years.
I mean, just to push back on that comment, I mean, if let's say you do have able to develop that mindset of like, all right, I want to hold this company for 10 to 15, kind of like what Value Stock Geek has. Yeah. I mean, at a certain point, does price really matter if you see that it's going to be a long-term core holding that you, based on your metrics, will appreciate at whatever percentage you think it will for that 10 to 15 years?
I think,
does it matter?
Someone else wanted, I think price, maybe I'm too old school, but I still think price matters no matter what. When you get into a stock,
I'm not saying it down. I'm just playing devil's advocate.
I understand. I understand that. And it's multiples. You also have to consider that multiples have expanded the number of growth stocks for years, right? And how much longer can that go? So even if you have a fantastic company with these what Peter Lynch used to call stalwarts, right? And it's growing at 5 or 6%, a little bit above inflation, you cannot only bet on either expanding multiples or on further operating leverage. So in some ways, I think it's tougher to find them, but easier to hold them if you can find a growth company younger in its life cycle. I think those in some ways make the best holds. In some ways, the easiest holds after you get through year 2 or 3 of holding it.
Easiest holds, but hard to easiest to hold, but probably much harder to find too.
Much harder to find. I agree.
Yeah.
But by the way, by the way, just looking at these, if you want to spend all of your hours looking at multi-billion-dollar companies that are quite expensive, those are very hard to find one you actually can put money into. So it's never easy, no matter what game you play.
It's true. No, it's all about doing the work. I mean, listen, I'm with you. I'm on the microcap side, right?
It doesn't even be microcap. It could be small cap. It could be mid cap. I'm just saying, some of these mega caps that have done well over 15 years, even if it is a Costco, I mean, it's tough. And I know he's actually not even going to buy Costco because of the price. But in some ways, I'd rather see someone with talent spend their time looking for the next Costco rather than spending a few hours looking at the existing Costco.
I'm a value investor. Jason, I'm never going to say price doesn't matter. I'm never going to say that. I don't think. But I will say that, on my continuum, if you like to put it that way, I think the price matters less with the core holdings, the more they are to the left, and it matters extremely with the short-term speculations. So, if I'm buying a short-term speculation based on what I think might happen with their drill hole play or whatever, I might buy it at 45, but I'm not going to pay 46. I mean, I'm very, very disciplined on money. If I have if I have a new investor, and I'm not actually buying Nestle now, but I want to buy Nestle, it's 98, it's 96. It doesn't really matter quite so much. And certainly with regard to selling, I'm not going to sell. If I expect to hold Nestle for the next 10 years, I'm not going to sell Nestle because it's moved a little bit above where I feel comfortable buying it. So I'm much more flexible on price. To me, with the core holdings, the quality of the company is so much more important than the price. I didn't say price isn't important. Whereas with the speculations, I think price is definitely as important as what you're buying.
Well, and the challenge, right, is like some of these companies in the late 90s, like an Amazon, right, took 10 years to get back to the price it was previously, even though the company was doing very, very well. But the problem is, right, when it's 1999 or 2000 or something like that, before the crash, you know, you did not have kind of fundamentals, you did not have profits, cash flow, and things like that to point to. And so that's the ones that I think just go in the too hard pile and you just miss them, you know, and maybe you pick it up in 2009 or 2015 or something like that when you do have a little bit more predictability in those financial results. And it's okay to have those too hard piles. You know, if people look back and they think, well, if I would have only owned Apple, you know, when Steve Jobs first came back. Well, why? Forget it. Don't kill yourself over that. You know, like there's no reason to beat yourself up because the characteristics at that time were not characteristics that were predictable enough, you know, to look fast forward 20, 30 years. But those companies at some point did have that predictability and, you know, then you can own them 5, 10 years from then, even though it's already run up 50 times.
Yeah. I made this same joke on an upcoming pod that I'm about to publish, but I'll say it first here. I think of myself as one of the best hindsight investors ever. Okay. I'm really quite good at, you know, at finding companies that I should have owned, you know, 15, 20 years ago. And as I'm sure most of you, we're all pretty talented at that as well. So here's my final question before we finish up here today. So I want you guys to make the case for why ultra long-term investing is not boring. And if if you were to still consider it boring, why it's cool. Okay. Let's make the case. What do you think?
Well, I'll make the case right up the
There
bat.
you go.
I think it was Jason, but we all know if you're in ultra long investing, once you've held it a certain number of years and once you're comfortable with the company, it takes a lot less time to follow those companies. So ultra long-term investing is a lot more fun because you have more time to do the things that you actually enjoy doing. Is that a good argument? Instead of being stuck in front of a computer all day long.
I think it's a great argument.
I think you do it for the stories. Look, you say, well, look, I owned Apple, you know, when it was 50 cents. I owned MasterCard when it was split adjusted foreign change. You know, those are great stories.
Yeah, I mean, if you want to be cool or you want to make money when it comes down to it, right? And not to say like ultra long-term investing is for everybody. Some people just don't have the personality, even if they try and study and they do Zen and they meditate, they can't get around to it. But a lot of people can move more in that direction. And by the way, if you don't even have the mentality to try and invest for a long term, I don't even know if you may not even get there, but at least you want to hold things for the medium term. You know, it's about making improvements in your process to try and grab more of those gains over time, and particularly in a taxable account. And we didn't really focus too much on taxes, but you know, we all know that if you just go back and forth and, you know, trade in a taxable account, that's no way to make money for the long term. So you know, I think making money is lots of fun. You know, I don't know about you guys, but that's what pleases me. And I agree, Steve. You know, it's nice to shift a little, you know, drop the MasterCard, you know, 456 story, boom, right on the table there. You know, if you're with other investors, bam, you get their respect, man. You know. That's it, instantaneous, you know?
Absolutely.
Yeah. And look, we're not here to poo-poo any other investing strategies. Look, as I think we could all agree, making money is cool and fun. And if you're making money doing, you know, being a day trader, you know, medium-term holder of some of these stocks, or you have 2-year time frames, power to you. It's all good. It's all gravy, baby. I mean, look, we're just, this is just something that, you know, as us, you know, 32-year-olds with young children start thinking about when we're putting together our Roth IRAs of like, you know, I don't know if I want to, you know, just trying to put together a strategy or adjusting a strategy to that new lifestyle, right?
Yeah. Well, you also have to say, okay, when you say what makes it cool, right? That was your question.
Yes.
How do you make it cool? This long-term, ultra long-term holding.
Yeah. How do we make it cool? That's the question.
Yeah. What circles are you playing in though? You know, it's if you're I mean, it's cool for us and hopefully the listeners to hear Jason, buying MasterCard, the IPO. It's great. It's cool for us to hear Adrian having a position that he's had for 30 plus years. Where are we at though? What cocktail party are we at here? Are we at a rave? And we say, well, I bought Berkshire in 1973, like no matter what we say, it's not going to be considered cool here.
Yeah. I mean,
so, like,
I'm at the age that why is the music playing too loud, right? Yeah. I can't tell my MasterCard story. The music is too loud, Yeah.
I mean, that's cool for this circle. So let's focus on our circle and maybe find a different circle instead of trying to make something cool that otherwise might not be considered cool in a different circle. Let's say we're the fish, right? Let's go.
We're making this cool for Gen Zers. Okay. Let's make ultra long-term investing cool.
Robinhooders. Okay. Yeah. It's not going to be, the story's not going to resonate with them. So let's go into a different pool, I think. I don't know. I guess maybe that's the fundamental question is the Robinhood traders, speculators, etc. How do they have any appreciation for this? Because you know what, 20% a year, not enough for them.
You know what? But I don't know about you, Steve. But I started off didn't do it for a very long time. But like looking at charts and doji stars and little triangles and things like that, right? And
Hindenburg omens
and all sorts of things, and it didn't work. Hopefully there are some young guys out there, right? If and maybe whatever you're doing working today, it may not work tomorrow. Right. And then, look at, in essence, look at the guys who've done well over time, right? Always look at the old rich guys and then ask, how do they get rich? And how do I get rich faster? Right. That's what every young person wants. Right? How do I get rich, as rich as you, but much faster? And then, maybe you'll pick up a little bit of knowledge listening to us old geezers. I don't know. That's what I hope for.
I mean, one of the things is, I think you're right. Some of these strategies simply don't appeal to certain types of people. I mean, I can say to somebody, look at Nestle, yielding, sometimes the yield's actually 3%. And if you'd have bought that in 1980 and you'd have held it up to now, look how much money you'd have. And you could think about when you retire or you send your kids to college. I mean, people who are 20 years old aren't thinking about when they retire, and something that yields 3% some years is just not appealing. And it doesn't matter how much, to me, it doesn't matter how much math you show them, it just doesn't appeal to them. But truth is, I think, and you can do this with part of your portfolio if you like, but the truth is that if younger people, I mean, to me, the normal paradigm is reversed. It's younger people who should be more conservative and focused on great companies that pay consistent dividends, and it's older people who should be speculating. Because when you're 75 years old, you've either got a bunch of money and you don't need any more so you can afford to have fun speculating, or you have so little money that your only hope of survival is to speculate. But when you're 20, that was meant to be a joke. When you're 20 years old, if you buy these great companies that are yielding 3, 4, 5, 6% and just let them compound over 20 or 30 years, I guarantee you, you're going to do so much better than the vast majority of investors.
And I'll just add one more thing, because as you develop that skill to invest in the great companies and hold them, you also sometimes get closer to building the necessary skill set to invest in soon to be great companies. Okay. And I have to mention Expel because it's like earnings day, right? And I own a lot of Expel. And there's, it's up like $8 right now, like today, right? And my average price in 2016 or so is $1.24. So imagine the gains just from one day, right, that you can have from a stock if you hold on to it. But so many people don't hold on to them, right? You got to be, if you want to make the money, you got to hold on to the great companies. And you got to, and if you really want the super great money, you got to buy them before they become great companies. But one way or the other, you got to hold on to it while it's great. So really, I mean, sometimes I'm just shocked that people just, work on holding, not just finding, work on holding.
You know, I think everybody listening that knows you, Jason, is like, wow, it only took an hour until the XBEL until the XBEL mic drop.
I wanted to start it with the MasterCard drop, and then I ended with the XBEL drop, you know, and then
you want to be cool. You got
I'm ready to cash out.
Yeah, bookend it like that. And I mean, look, what's cooler than making a shitload of money? These positions. That's actually how you that is how you attract, you know, the Robin the group.
Exactly. You know, everything, and I hate to say it, but like, you know, if you look at like Hold'em poker, right? You need the Chris Moneymaker. You need somebody who's done really well, and somehow the personality, and it just attracts the other players. Some of which, and I'm not Chris Moneymaker. I don't want to be Chris Moneymaker of the microcap world. But you know, here I am, just a small businessman, right? And following these tactics, really tremendous like financial security for like myself and really generations now of like.
Yes, rub it in. I mean, 5 or 6 generations from now, based on the
maybe thinking about like future generations is like, that's the most uncoolest thing to talk about with a Robin Hooder. But you know what? I think it's, you know, when you have kids, you start thinking about their futures, right?
Next time we have a podcast, you're on one of these podcasts, Jason, would you please wear your diamond encrusted, thick necklace so everybody
I need like the Mr. T diamond, all the
I mean, like thick, and it's all diamonds.
All diamonds. Diamonds.
1% of the
show my hands because my fists are all diamonds. That's right.
Oh my God,
that's from 1% of the gains. 1%.
Oh man. Well, I think that's a great place to end it right there, gents. So with that, where can everybody go and find more information about you, follow you on social media and stuff like that? So Jason, where can people go and find Diamond Hands Jason?
Find me on Twitter at 8track180. You can find me on MicroCap Club, and you can just find me at Hudson 215 Capital. That's where you can find me.
I don't know what all those things are. I can give you my Pony Express address. No, our website, we do have a website, is adriandayassetmanagement.com.
Very cool. Don't worry, we're going to get Adrian on social media at some point. We did a lot for Kevin Shea and his social media following. So come on, jump on. We can help. We can do a lot for you, Adrian.
The program.
That's right.
And Steve.
So I'm going to give you a new one here. We're on Clubhouse.
Yeah, I just got that.
On Clubhouse, we started a club, Willow Oak Funds. We're having happy hours, virtual happy hours. Got one on Monday at 4:30 p.m. Eastern time on Clubhouse. Follow Willow Oak Funds, follow Arquitos there, and then you can link out to all the other good stuff from there. So check out Clubhouse. It's been a lot of fun.
Nice. I'm excited to check. That will be my second Clubhouse. I'll be honest, the first time I jumped on Clubhouse, I thought people could hear me. So I turned it off real quick. So I was like, I had like a boomer millennial moment. You know what I mean? But anyways, with that, gents, thank you so much for joining us today. This was a lot of fun. I hope everybody listening got a lot out of this. Again, my name is Robert Kraft. You can follow me on Twitter at Bobby K. Kraft, BOBBYKKRAFT. You can listen to every episode of the Investors Roundtable on our YouTube channel, youtube.com/SNN Wire, and the audio version on the Planet MicroCap stream. Have a great weekend, everyone, and see you next week.
Thank you very much.